Greetings, and welcome back to the Rose Bros podcast. This episode, we are joined by Simon Belanger, co-host of the Canadian Investor Podcast, a podcast for Canadian investors that features in-depth discussions around individual stocks, investing strategies, and investment vehicles. The show has grown to be a Canadian favorite as it racks up millions of annual downloads and is a top-ranked podcast across all platforms. We sat down for a smooth cup of Rose Bros coffee and discussed building and monetizing a podcast, why cash can be a good thing during inflationary times, REITs, and how interest rates are impacting Canadians. Enjoy. Also, apologies in advance for the scratchy audio. We had some difficulties while recording, but you should be able to hear the conversation. This podcast is sponsored by headracingcanada.com. Looking for high-performance ski gear this winter? In partnership with four-time Olympian Manny-Osborne Paradis, headracingcanada.com is offering the lowest prices possible through its online storefront by passing brick-and-mortar savings on to customers. Check out headracingcanada.com for more info and get your high-performance ski gear for the upcoming season. If you're ready, we can hit record.
Yeah, go for it.
For the listener, you are the host of the Canadian Investor Podcast. What is the Canadian Investor Podcast?
So the Canadian Investor Podcast is this podcast that I started with my co-host, Braden Dennis. We started that about late 2019 is when we started it. And our goal was to bring a podcast that focuses on investing, but more from a Canadian perspective. So we still talk about, American companies. We talk about concepts that could be useful wherever people live, whether they're Canadians or not. But being able to talk about things like tax-free savings accounts, so TFSAs, RSPs, RESPs, so things that are more specific to Canadians. And we do try to, as much as possible, put in some Canadian companies as well, some Canadian content. And at the time, there just was not much out there. There was a lot of good investing podcasts, but they were predominantly, and rightfully so, US-based and US-focused.
The Canadian Investor Podcast came up on my recommended suggestions in Apple, so things must be going well.
No, it's going pretty well. It's, like I said, it was about 3.5 years ago that we started, and it was kind of funny. We didn't know each other. Braden had done some podcasting on his own, on and off, not very regular, so sometimes he would post and not put out a podcast for some time. So I'd noticed that. I kind of liked his style, so I reached out to him. He lives in Toronto. And then I happened to go for a work-related training because I'm in pension retirement. So it was a pension training. I went to Toronto and we met up, had a drink, and kind of talked ideas. And we're like, you know what? Let's just give this a try. Both something that we're passionate about. And here we are 3.5 years later.
What does doing well mean in the podcast world? What kind of numbers are you guys seeing for the listener, and what kind of reach have you been able to get?
Yeah, so we do 2 episodes a week. So in terms of per episode, we do, on average, I'd say like 14,000 listen per episode. So on a monthly basis for downloads, we're looking at about 170,000. It was already, for other podcaster, like December is always a slow month. So don't be too hard on yourself if you see your numbers dips. But then for us specifically, January with New Year's resolutions, a lot of listeners, we've seen the numbers tick up. And we also have a real estate investing podcast under a network, which is called the Canadian Real Estate Investor. So they've been doing great as well. They started last July, so it's been 6 months, and they don't have quite the numbers that we do, but still really good considering it's only been 6 months and it's a bit more niche.
They're also doing really well. I've noticed a few really high-profile guests on that show, a few billionaires even.
Yeah, Dan and Nick, they do a really good job, and they have a good rapport in between the both of them, and they actually do business deals for real estate together. So you can tell there's a good relationship there too.
Also, to give the listener context, your podcast has grown to the point where it is ad supported, and in the era of podcasting and media and whatnot, content creators, you can actually make a full-time living or at least a part-time living on it.
Yeah, exactly. So I do this part-time. It used to be that we both had a job. Now Braden also has another business called Stratosphere.io that focuses more on investor tools. So he's kind of left the regular 9-to-5 world a few years ago. I'm part-time now, so I focus part-time on the podcast, and then I make enough of an income to only work part-time with my other job. And definitely I would say we're pretty much always booked in terms of advertisement. We only do 4 campaigns running at any given time because we played with it, and we also listen to other podcasts, right, where some of them already had ads, and we noticed that, at some point, some try to cram in too many advertisement and just ruins the listener experience. So we decided that 4 per episode was kind of the top we wanted to do. We would have had opportunities to have more, but that's something we decided for the quality of the content. And we've refused some advertisers too, right? I think that's important for people to know. You want to have credibility with your audience. If something doesn't fit with what your ideas are, what you preach as well, I think saying no, even if it costs you a little bit of money, I think longer term, it's probably the best thing you can do for your podcast.
In terms of content and ideas and subjects to talk about, do you guys brainstorm once a week and schedule things out a month ahead of time, or how does that work in that sense?
Yeah, so we have one of our episodes is more focused around news and company earnings. So when companies release the financial statements quarterly, so we'll kind of focus that on one of the shows. So that's pretty easy, right? You kind of look at what's going on in the news and we give our takes. And then the other episode, we focus a bit more on concepts and maybe doing a deep dive on a specific company. So usually we'll do about 2 segments each for those episodes. So we kind of come up with segments, we'll text back and forth, and we'll kind of go at it. So we'll each have a segment, and then the other person will kind of chime in a little bit as we go. But people have said that, feedback we get is it's not a boring investing podcast. So I think they can relate with us. We've learned, I have a pension retirement background, so I've learned quite a bit from there in terms of investing, but I've done it a lot myself. I'm not a CFA, neither is my co-host. So we're self-taught, and I think it's encouraging for a lot of people. We're honest about what we invest in. We're honest about some mistakes because everyone makes mistakes, and a lot of investing videos or podcasts, they tend to not talk about their mistakes. So I'm more than happy to talk about them if we all make them, and as long as you learn from them. That's how we approach it.
When you started the podcast, was the goal to grow it into something that could be a viable business, or were you doing it as a creative outlet, or what was the idea behind it?
No, it was just a passion project. So we started at 1 day a week, and that was time consuming. It wasn't too bad. And I was joking with my girlfriend, who's now my wife, at the time, and she would be joking that we'd be lucky to get 200 people listening per episode. So, it definitely grew a lot more than our wildest expectations. And we didn't really have a goal to monetize it early on. But then about a year in, and the numbers we were having, we chatted with other podcasters, and we realized that we had something there, especially for advertisers that are targeting Canadians. Even though it's not all of our audience that's Canada, I would say it's about 90%, and then the rest is US, and then 5%, and the rest of the world, the other 5%. But we weren't thinking about that. But for advertisers, it's very attractive if they're wanting to reach Canadians, because that's predominantly our audience.
You guys do a format where you talk to each other. There's a co-host, so you kind of bounce ideas off each other and discuss things instead of always getting guests, which seems to do well because you don't have to worry about getting a guest every single week.
Yeah. Yeah, we do have guests from time to time, but it's true that a lot of podcasts, they tend, and I wouldn't say, I don't know the exact data behind it, but a lot of podcasters, they tend to have guests, right? So that's what a lot of people do, and it's not always easy to get guests and so on, and try and make that work. So we do incorporate guests every now and then, but the feedback we had from our listeners is they enjoy listening to kind of our banter back and forth. They do for the most part, we try to make it accessible for as many people as possible. So when we talk about concepts, we try not to take for granted things that, we've known for a while, but we try to explain to it. It could be we're talking about higher interest rates with the Bank of Canada, for example, and we'll talk a lot about basis points. So we'll kind of explain what that means when will say, oh, it increased 50 basis points, for example. So we try to give that. I mean, for the most part, feedback has been overwhelmingly positive. Some people would prefer that it be more into the technical, in the weeds, very advanced. But again, we're trying to make it as accessible as we can for.
Did you kind of sense there was a hole or a opportunity for the listener that was looking for basic information on investing in Canadian investing, or what gave you the idea to go down that niche? Was it just your own interests?
I think it was our own interests. Also, with my work, I do presentations. I work in a space that people should know about investing, yet I've noticed very early on when I do presentations where even the very basics, people just don't grasp those concepts. So that was a big haha moment, if you like, an epiphany for me, where clearly there was a need for that, and just people where they can learn and it's just not too intimidating. Because there's some really good podcasts that I listen to, but early on when I started listening to those several years ago, as I was getting more comfortable in the investing space, a lot of the time I found myself having to Google stuff, right, to understand what they were talking about. And we're trying to avoid that for people so they can just learn about it as they're listening. But I think it would be a mix of everything: passion, not having anything really available in Canada aside from the traditional media, and the things we noticed.
Have you noticed that some competitors have popped up now that you guys are having success, or is there much competition in this space, or how's that going?
Yeah, I mean, I think there are some in Canada. Definitely, there are other podcasts. I think they may have their audiences, but I think for the most part, when you're doing a podcast, and I'm sure you listen to other podcasts too, right? And you almost feel like you know the person talking. You almost feel like you know them on a personal basis. So I think that rapport that you have with your audience can be really strong. And as long as you provide value to them, I think they'll stick with you. And like my co-host will say, I mean, at the end of the day, the biggest competition is probably not other podcasts. It's probably more like traditional radio and traditional media, right? People only have a certain amount of hours in their day. And I compare podcasting a little bit like you would compare streaming with traditional cable, for example. And I think it's a huge advantage compared to radio shows because you can listen to it on demand. I don't know if you have kids, but I have a baby, and, if there's a radio show I would like, I mean, she's not always going to be cooperating for me to listen to that radio show. But with a podcast, I can actually, when I do have free time.
You're not giving predictions or anything like that, but what are you seeing in Canadian economy in terms of rising interest rates, and how is that impacting the economy?
The way that interest rates have risen, they've risen so quickly. We haven't seen that. I think the last time was early 1990s, late 1980s. So before, I think, I don't know if you were born. I was born, but I was too young to probably tell what was going on. And so they've risen extremely quickly. So what's probably going to happen is you have a bit of a lag effect, right? So it's a bit unprecedented what happened. For example, if we go back to July, I think, where the Bank of Canada raised it by 100 basis points. So if we go back to there, I mean, these are really quick increases, and economists don't even agree to that. But for the most part, when you have an increase, it takes about 6 to 12 months to see the full impact. So we're not even the 12 months after they started really hiking them, because they did, I think, 25 basis points early on, and then they've really ramped things up. So I think you're probably going to see, unfortunately, some people, we're starting to see people struggling with variable mortgages, for example, that own their home. I know some mortgage brokers, and one of the co-hosts of our real estate show is, and I've been interacting with Dan, the other guy, and it feels like a lot of people are making it meet that have those variable rates right now in the hopes that the market will pick up in the spring. But we'll see if it picks up, because interest rates, right, are much higher, which means the bar for those stress tests goes even higher. So people may be looking at their neighbor that sold the house last year in February at the peak and say, well, why can't I get that? I mean, I might want to buy your house, but I can't even get approved because the bank won't approve me for that kind of mortgage. So I think we're probably going to see the housing market at the very best trend sideways this year, but I wouldn't be surprised for the most part still see some downward trend just because of the purchasing power is just smaller for people. And I would say for the economy as a whole, jobs have been pretty resilient, which has been a bit of a surprise. So we'll see what the Bank of Canada will do going forward, because their thing is almost to quash job growth, because they feel like having too many vacancies leads to more power in the hands of the workers, which, asks for higher wages, and then it's kind of a spiral. So that's their whole premise on the inflation and trying to crank up interest rates so that job market cools down. Most people think we're going to enter into recession at some point this year if we're not already into one. So I think there's probably going to be some pain to come, but for the most part, I'd say like my best advice to people is stay away from high interest debt, and there's a good side to higher interest. You can get some pretty good interest on savings accounts and GICs and things like that. So try to use those to your advantage as well. And kind of power through while rates are high. They'll probably remain high at least for the next couple of years.
There's a great Twitter account I follow, a car dealership guy, and he has even had Elon comment on a lot of his tweets and whatnot. But apparently the interest rates are affecting everything, even now, even getting into cars. So people are looking to buy a new car. It's becoming a good time to buy again with increased supply. And then a lot of the auto loans people are having trouble. So there's going to be some opportunities coming up. So if people are into buying a new car, it may be a good time to be looking into that as well.
Yeah. Car purchases are notoriously interest rate sensitive. I mean, I think Tesla reduced their prices for new Teslas. I think it was a couple of weeks ago, if I remember, or it could have been this week. So they're definitely seeing a slowdown. So you're seeing industries that, especially larger purchases that will typically be financed, those are starting to be a bit hit harder. And obviously used cars were hot commodities until probably last spring. I think it kind of peaked there in the US. I think used cars prices were down like double digits or pretty close to that on the latest CPI or inflation print that comes out of the US. So definitely if you're, I'll tell everyone, I mean, I know it's a bit predatory, but when you're in a buyer's market, whether it's purchasing a house or a car, you have to try and get the emotions out of it, and don't be afraid to lowball people. Like, as bad as it is, I mean, we're in a capitalist market. You have the upper hand. So if they don't want to take your offer, they're offended, whatever, just move on to the next one.
Another thing that helps put the interest rate rises in context, at least for me, is that we're actually trending back towards a more normal interest rate, not just historically low. For the last 5-10 years, they've been unprecedented how low they've been. So to get back to 5, 6, 7, 8% is actually probably, you could argue, healthy for the economy. I don't know how you think of it that way.
Yeah, I mean, low interest rates, it's really fueled with speculation, right? Because you have a low interest rate, so what are you going to do with your money? Put it in a savings account and get 0.25%, if that, right? That's pretty much what we were used to, at least after COVID hit, when the interest rate got really, really low. So when people can't save money, what they do, they either go ahead and spend the money, or because they figure that if they wait, their purchasing power will just go down even before inflation started picking up. I mean, if inflation is 2% and you're getting 0.25 on your money, you're still going to be lagging behind. Or people invest in higher risk assets. So whether, we saw what happened with crypto, we saw what happened with growth stocks, for example, and these things, people just poured money in it because that's the only way they could try and get some returns in their mind. So these things got really bid up, and I think it was definitely a bit unhealthy. And then a lot of people who started investing when the pandemic started got a grim reality that it doesn't always just go up. There can be, and there will be, corrections. So I think, just like you said, having the higher interest rate and giving the opportunity to have better rates on, savings account, GICs, money market funds, whatever you're looking at to park your money a bit more safer, it definitely gives you some options. I mean, you're still losing a little bit of money if you compare it to inflation right now. But again, depending if it keeps trending down, it could be a good bet as well.
I think it was Nassim Taleb who said it's during inflationary times, the way you think about it is cash is actually a good thing to have, because if you can get an inflation index match cash product, you're getting a decent return as interest rates rise and inflation rises. I don't know if that's accurate or not.
I think he's talking probably about TIPS. So these are basically government U.S. treasuries that are tied to inflation. So I think that's probably what he's talking about. Yeah. So, I mean, it's good to have that during inflationary times. What does happen too with inflation, especially with higher rates, some sectors will really get crushed. And we've seen that last year. I mean, if people are interested in investing in real estate but don't necessarily want to be an active investor, there's something called REITs, so real estate investment trusts, that are traded just like stocks. And REITs have been completely destroyed last year. They're, I think, one of the worst performing assets, down like 30%. So, yeah, inflation was high, but usually the reaction to inflation from central banks is higher rates, and higher rates can really pull down certain sectors. So if you're an active investor, I mean, it does create some good opportunities. I'm not saying go invest in REITs necessarily, but I know some names that are really attractive right now, and that's something I've been putting some money in the last couple of months, because I think there was a bit of an overreaction with these higher rates.
The reaction comes because a lot of the REITs use borrowed money to grow and to expand, and they can't increase their rent because it's rent controlled, but not all real estate markets are controlled. So some are able to increase rents, if I understand it correctly.
Yeah, so REITs as a whole, it's a pretty wide category, right? So what you're talking about would be more like apartment REITs, for example. So they will just have big apartment buildings. And obviously in Canada, we have some pretty strict rent increases, usually low single digits. But you could have industrial REITs. That's another example, these big distribution centers. You can also have retail REITs, pretty self-explanatory. So all these different kind of REITs, they do have some pricing power. You have REITs where office space, that one has been really hit hard because everyone thinks we're never going back to the office. And then these REITs are one, I would say, the ones that were, I think, the most impacted altogether last year, because the vacancy rates are much higher. But if you're able to look longer term, that's how we invest. That's how I invest. I don't really care about what's going to happen the next year or so. I try to think 5-10 years down the line, and do I think this is going to be a good investment? So REITs can be really attractive that way. Some have been performing better. I mean, one of the areas that perform pretty well are data REITs. So these big data centers, they have tenants like Amazon Web Services, Microsoft Azure, and things like that. So there's a wide range of REITs that you can have. So there's definitely some good opportunities, in my opinion, there.
Aside from real estate REITs and inflation indexed cash, more or less, are you seeing any other opportunities in this environment for the listener?
Yeah, so I think tech is interesting. Not all of tech. My best tip, and not just tech, but in general, if you're going to invest in specific businesses right now, you want to make sure the business is a good business. So what I'm talking about here, the revenues are growing. The profit margins are maybe shrinking a little bit, but not too much, because, businesses are feeling inflationary pressures as well. And they have good balance sheets, so not too much debt, and they are able to properly service that debt. So pay the interest on that debt multiple times over with their operating income. I think those are the things that people should really focus on when they look at businesses right now, and they produce cash flow. That's really important, because that means they'll be able to survive. We talked about that not too long ago, called zombie companies. And these are companies that have a lot of debt. They can't even service the debt, so pay the interest on their debt with their operating income. So what happens usually is when the debt comes due, or sometimes they just don't have enough money to even just pay the interest, well, usually what will happen shortly after is bankruptcy. And we've seen some domino fall already. I mean, Bed Bath & Beyond is not bankrupt yet, but they issued a notice like a week and a half ago, and it's just trending that way. The numbers I saw from, I think, Goldman Sachs, they came out and they said there's about 10% of all publicly listed businesses that they would consider zombie companies. So all that to say, I would focus on quality, but definitely text-based communication has also been hit quite hard. Like I mentioned, the real estate space as well. There's a couple different other areas. Utilities were hit pretty hard as well. Just the businesses that kind of sell electricities and stuff like that. Definitely focus on quality over trying to, let's say, bargain basement value.
It doesn't seem like the rate increases are over yet. In the case where rates continue to rise, do you see major impacts on the economy and more correction coming down the line? Or how do you think of it that way if rates continue to go up?
Yeah, so the Fed is, the Federal Reserve in the States, and in Canada, we like to think the Bank of Canada is important, but in reality, nothing really matters other than the Fed. That's really what, all central banks in the world, they tend to look at the Fed and what they're doing, maybe with the exception of like China and these countries that are a bit more hostile towards the U.S. and want to have their own monetary policy. But they've said, I think the most recent announcement from Powell regarding the terminal rate, so the terminal rate is just the max rate that they'll be reaching, is around, I think, 5.5% now. They originally said 5%. I think now it's 5.5%. And the Fed is a committee of people, but Jerome Powell takes the decision. So keep that in mind. And it's funny because they'll kind of roll out some other people to push a message that they're looking for. And the message that's been coming for the most part is that rates, it looks like they will be topping out soon, but they will most likely be staying there for a while. So what they want to do is almost want to see all the increases that they've done and the impact it will have on the economy and kind of gauge where they want to go. They don't want to raise and then go down and just to realize that they need to raise again. But clearly it does have an impact on the economy because businesses, the cost of borrowing is more expensive. If you have some entrepreneurs that are listening here, I would definitely say try avoiding variable rate debt. So these credit facilities, which are basically margin lines of credits for businesses, that's something I really zone in when I look at a business. Is I'm not too fond of seeing that, and you can usually spot it just by looking at financial statements where you'll see the interest costs go way up within a year. But there's, if you look at the notes, the subsection notes, usually they have to actually tell you what their debt is. So I would say, it's hard to say. I'm not good at predictions. And I mean, even the central banks are not good. But clearly, the more the cost borrowing goes up, especially in Canada, where we're so tied to housing as well. Think about the realtors that you might know. I'm pretty sure if you talk to them, they're going to tell you that they haven't been making a lot of money in the past 6 months, for example. So that kind of has a ripple effect and everything tied to construction. And I don't know about Calgary, but in Ottawa, I've definitely noticed where you have these buildings that it was clear they have this notice, from the city saying that they'll build a building, and the notice been there for like a year and a half, 2 years now. So I've seen an increase of that. So I think if you think about all the jobs that are related to the construction sector that could be affected by higher rates and then potential bankruptcies and so on, I don't want to be a doomsayer or anything like that, but I think it's probably going to be a bit rougher next year or two in general if the rates stay that high, but it doesn't mean that you can't find some good investment opportunity. It's usually when the best investment opportunities kind of come up when people are the most pessimistic.
On one hand, inflation is super high right now, 8, 9%, 10%, depending on who you ask. On the other hand, interest rates are going up, which makes it hard for the average consumer. So you're kind of trying to weigh the two things. You can't have high inflation because it basically destroys civilizations. But on the other hand, rising interest rates make it difficult for the average Joe. How do you think of it in terms of weighing the two, super high inflation or low inflation versus interest rate levels? Do you think what do you think is the right course of action?
I mean, I wouldn't want to be in their situation. I think, I was pretty vocal on the podcast in 2020, 2021. I just did not understand why they were keeping these rates that low. And now you're kind of stuck in a situation when you're backpedaling, right? You're basically overcorrecting. There's the risk that you're overcorrecting, right? So you were too pessimistic, so you kept rates too low. and then you're you're afraid that things are going too well, so you want to increase the rates. They don't have an easy job, because when you think about it, the two mandates that they have are actually competing against each other. So for the most part, they want to keep on, unemployment low, employment high, and then inflation low. But these two things if you raise rates, chances are that unemployment is going to increase. So you have to really balance those two things. I'm not sure what the right approach is. I think the one thing I would probably do is trying to go away from that 2% target that they have. I think it's between 1% and 3%. So we always say 2% because that's the mid-range. I think that's just it's an artificial thing that was, I think it came out of New Zealand in the 1990s, and then most central banks kind of followed suit. But before that, there wasn't a specific target. So either that, or you readjust that target to maybe something more around 3-4%. Not ideal, because you're still losing purchasing power relatively quickly. But I think, having that steadfast stubbornness, I would say, almost on that 2% target. I mean, Tiff McLean reinstated that recently, so that they're, zoned in on that 2%, and they're not happy until they get there. So I probably would say having a bit more flexibility on that. But yeah, I think right now, probably the way I would look at it is probably keep rates as is for a little bit, and just see, give it 6 months, maybe a year, just to see how the lagging effect kind of hits the economy.
Another argument is that these are complex systems. Again, Nassim Taleb would say it's impossible to know. We're dealing with something that is very hard.
Exactly. And people sometimes forget, but as interest rate rises, the government debt payment, so the interest rate on the debt when they're issuing debt, also rises. So it has that impact. And we saw the gilt market in the UK. So those are sovereign bonds from the UK government. I think it was it Liz, the lady that's Liz Truss? There you go. I think she was in office for a month or something like that. And they came out with a really, I would say, bold plan, but it was a bit reckless, and the market basically smashed the UK bond. So the gilt is the UK bond. And what happened is the market are like, okay, if they go ahead with this plan, they actually will probably have to default on their debt. It's an oversimplification, but essentially what happened is the price of the gilt dropped, meaning that the interest rate on it skyrocketed. So the central bank had to intervene. So that's really the danger too, is depending which way the central banks go, they could break something. So that's really, it gets really complex, but something could break. You could have a default of a major economy, for example, a major country. We're used to emerging markets defaulting on their debt, but we've never really seen a major economy happen. And it definitely opened some eyes, I think, when the UK gilt market plummeted a couple months ago.
Another aspect is, like you're saying, that U.S., Canada has record high debt levels coming out of the pandemic. I think I read that Bank Canada was losing money as it is right now on a bunch of its bonds and whatnot. So that is another consideration that goes into it, obviously.
Yeah, exactly. So, I mean, there's so many things. Like, there's economists and people that are way more qualified than both of us.
Yeah.
I would not want to be in their shoes right now, but it's something I'm really interested in. So I read quite a bit on it. And as interest rates rise, I mean, we've seen it. If you're in the stock market, for example, because the podcast, we talk mostly about stocks, but we do talk about other things like, every now and then we'll talk about bonds, a little bit about Bitcoin too. And, people have to realize that this is a bit unprecedented right now. And you're going to see volatility. So I think that's something you just have to get comfortable with. And as long as you have a plan, and personally, I think as long as you're thinking more long-term, you'll be fine. But, you could have a year that your investments are down 20-25%. I mean, the S&P 500 in the US was down 20% last year. So you have to be able to remain calm and not panic, because the macro stuff is going to have a big impact on what the stock market does, at the very least in the shorter term.
Well, that's awesome. You are not a stock advisor and you don't give advice, stock picks, but if you were to give general advice to the listener on how do you be defensive or prepare for the uncertain economic times ahead? What would you say?
Yeah, I mean, I would say the first thing that everyone should have is just an emergency fund. So the typical advice that like CFAs or financial planners will give is 3 to 6 months of expenses that you have in cash. And right now you can, a lot of savings account will give you 2.5, 3%. If your bank doesn't give you that, switch banks. But I mean, they make a lot of money with fees and stuff. I'm not afraid. I've switched banks before. Another option, but it's not CBIC insured, is having money market fund. So these are like traded like ETFs, and they're very liquid. And right now you can have 4.5, close to 5%. The only thing is they're not insured by the Canadian government, but for the most part, they're deposited at, one or a couple of the big 6 Canadian banks. So they're fairly secured. So I would say that's the one thing, I think, if you have investment, because if anything happens, you have an emergency, you need the cash, you don't need to go dip into your investments. That could potentially be at all-time highs or all-time lows, right? So you don't want to be selling when they're at all-time lows. If anything, you want to be adding to positions that you have strong conviction in. So that would be the first thing. Take the time to just know the basics if you're going to invest. It could be just to learn how ETFs works in general, because I think ETFs, broad-based index funds, are a great option for people, especially if they want something that's not time-consuming and they don't want to put hours and hours to learn and invest in a given business. Try to lower your fees as much as you can. So Canadians are notorious for paying high fees with mutual funds and banks, so pretty difficult to pay 2%. But use a compound interest calculator, play with it, and put, 0.15% fee versus 2% over 20, 30 years, and you'll be floored how much of a difference it can make. And like I said, have a long-term approach. And something that's definitely underutilized in Canada is use a tax-free savings account. But it's not just a savings account. So I think that's really important. I think the latest data we looked at was like 50% of Canadians use it as just a savings account. Well, you can actually have the same kind of investments in a TFSA that you have in RRSP, for example. So you can have stock, bonds, money market funds, like I said, GICs. So things that give you a lot more interest than just a savings account. You can have a savings account, which is fine. But especially if you have room, you basically get taxed as you get paid by your employer. Then you put the money into the TFSA, and whatever it grows into profit, dividends, as long as they're Canadian companies, none of it is taxed. If it's a foreign company, a U.S. company, it'll be taxed at 15%. But you don't see that. It's actually taxed by the U.S. government, so it's a withholding tax. So when you get into your account, it's already good. But use those tools that are available to you that also underutilized. That would be my best advice there, and be diversified, right? It's probably controversial a little bit, but I do own some Bitcoin, for example, but it's not a huge allocation of my portfolio. It might be a bigger allocation than a lot of people would be comfortable with, but if you can use allocation to place bets on things that may be a bit riskier, but it's a small enough portion that if it goes to zero, for example, you're not crippled. I mean, I think that's really important because, if you have 90% of your portfolio in blue chips stocks, for example, and then the rest of the 10% is just, higher risk investments, if you're fine with that, that's okay. Because even if the 10% goes to zero, you're still okay, right? For the most part, but maybe one of these investment 100x or whatever it is. So it's a bit of an asymmetric bet, but you can really control your risk by doing proper allocation like that, and whatever you're comfortable with. What I'm comfortable with will be different what you're comfortable with. So using that, and I would say also be careful with penny stocks. I think especially beginner investors, they tend to gravitate to these low price stock. And I'm saying low price as is a dollar value, not a low valuation where the company is priced attractively. So people see a $1 stock and they figure in their mind, if it doubles to $2, only needs to go to $2 and I'll double my money. Well, there's a bit more to that. Yeah.
Well, that's great. I really appreciate your time explaining the Canadian Investor Podcast and a little bit about the markets, interest rates, and where things are headed. If the listener wants to learn more about the Canadian Investor Podcast, where can they find you guys?
Yeah, so you just go on your favorite podcast player, whether it's Spotify, Apple Podcasts, SoundCloud, whichever one, we're all on there, and just type in Canadian Investor will pop up. You can find me on Twitter at fiat_iceberg. So you can find me there, or the official Twitter of the network is at CDN_investing. So you'll be able to find me there. I tweet a decent amount, not, sometimes I'll tweet 4 or 5 times in a day, but then I won't tweet for a few days. Having a newborn child, I kind of try not to be too much on my phone.
Awesome. Well, thanks a lot. I really appreciate your time. I can end it there. Thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out rosebros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.